Welcome to the Academy of Ideas Economy Forum. I'm Rob Lyons. I'm the convener of the forum, and I'll be chairing tonight's discussion on COVID-19 and its effects on the oil industry. I was just reading the Guardian's report on the news that BP is to cut 10,000 jobs worldwide, and I thought it was a very useful microcosm of the problems facing the industry today. So, according to this report, at the start of this year, the price of Brent crude was around $65 a barrel. But at one point in April, it fell to $16 per barrel. And there was a point where prices went negative in daily tradings. People were basically trying to pay somebody to store their oil or take their oil off the hands. Now, prices have rebounded since then, and I'm sure our speaker will go into all the reasons for that. But the losses have been enormous. So BP's chief executive, Bernard Looney, said that the BP had lost almost $5 billion this year. And he added that he's more convinced than ever that the company had to embrace the energy transition, arguing the pandemic only adds to the challenge that already exists for oil in the medium to long term. So while BP continues to flirt with going beyond petroleum, what has been the overall impact on the industry? Can it recover? What are the wider ramifications of, for example, the downturn in US shale oil production? And is oil really doomed? What's it mean for the wider picture in terms of commodities? So there's lots to talk about tonight. Just before I introduce our speaker, a quick word from our sponsors. The Academy of Ideas is continuing to work throughout the crisis. No staff have been furloughed. In fact, we're working harder than ever. All our online events during this crisis will be free and available to anybody with the means to log on. We'd be really grateful if you could consider giving us your financial support if you haven't already. If you would like to make a donation, small or large, go to academyofideas.org.uk/donate. So over to our speaker tonight, it's Robert Figg. He's a seasoned commodity risk practitioner. He's a principal at Metals Risk Team, which is a commodity risk management consultancy, and he's previously worked for ArcelorMittal and for London Metals Exchange. So Rob's going to talk for about 15 to 20 minutes, and then I'll open up the floor to discussion. So hopefully I can find Rob to unmute you. There we go. Are you unmuted yourself? Have you, Rob?
Yeah.
Excellent. Right. So I've spotlighted you, and the floor is yours. Away you go.
Okay. Hello, everyone. Thanks, Rob, for the introduction. What I'm going to do is to talk for about 20 minutes on what happened, what's been happening in the energy markets over the last 3 or 4 months, just to kind of situate this discussion, and then to have a look at the wider global economy and to see what impacts these events could have on recovery and the future for the world economy. From January, when oil was trading at $65 in America, the contract there is called West Texas Intermediate. It's an oil-based contract that is traded out of the New York Mercantile Exchange, and it is based on physical delivery in a place called Cushing, Oklahoma. So oil was trading merrily at $67 a barrel. The world production of oil at that time was 100 million barrels per day. That is consumption, and 99 million barrels a day was produced. So we had a slight shortage of oil going through through January and February. What happened then was the Russians and the Saudi Arabians entered into a price war by flooding the market with oil. The idea behind this was to remove some of the marginal producers who produce at a much higher level. We're talking particularly about the United States, where shale gas and shale oil means that a barrel costs them about $60 to $65 a barrel. By pushing down the price of oil, by flooding the market, they were attempting to drive the Americans out of the market. over the last 5 years, America has become self-sufficient in oil. And one of the consequences of this was that prices dropped first down to the low 50s, and by March to $23 a barrel. Come along COVID, where this 100 million barrels per day looked very optimistic, and in actual fact, consumption dropped to below 70 million barrels a day. There was a huge drawdown in production, in consumption of oil, while production continued at the same level. And what happened in April, culminating on the 20th of April, which was a pretty historic day for the oil markets, when the WTI May contract ended at minus $37 a barrel. That's the first time that has ever happened to a market where it had entered into negative territory. Now, to explain negative pricing, just think about, you've got a piece of furniture that you want to sell on eBay. You advertise it, nobody's interested. And what you have to do eventually is to pay the council to come along and take away your piece of furniture, despite the fact that you think it has some value. In this instance, prices started declining very rapidly, and the storage of oil was filling up all over the world, not just in Cushing, Oklahoma, but all over the world. What happened here was that there were a large number of, one of the things about West Texas Intermediate is it tends to be what's called a financial market. It's not a market where people tend to go to manage their risks through hedging. They would tend to use the Brent contract, which is pretty similar, traded here in London on the International Commodity Exchange. The WTI contract tends to attract the financial markets and the retail markets through what are called ETFs, or exchange traded futures contracts, which mimic the price of oil. And so what you had are these huge retail funds that were what we call long of oil. They had bought forward their oil contracts. And for them, those invested in these markets, the price went against them, and it started falling and falling and falling, and eventually entering into negative territory. And that means that they have to buy back their contract at much lower prices. The consequence of this is on the NYMEX contract, the WTI contract, you have to take physical delivery of that oil if you cannot settle financially. And the problem is that storage in Cushing was basically full. And so people had to close their position out at whatever price they could, leading to that negative pricing. So people can't, you can't just let your futures contract expire without closing it out. You have to close it out prior to moving your position to another date, or rolling your position forward, as we call it. And when they did that, unfortunately, they first of all they lost money by, let's say they sold the May contract in January at $70 or $65, and it had gone to minus 37, they'd basically lost $90 per barrel. They then had to roll their position forward, because these are long-term funds. And so what they did was they rolled their position into the June contract. And the June contract was trading at a much higher level. So they sold at a loss, and then they had to buy at a higher price in the future. So they got hit on a double whammy. On the one side, they lost money on their original trade, And in the second case where they rolled their position forward, they also got hit on that. And that, what we call the price differential between today and tomorrow is called a contango. If the low price today is lower than tomorrow, that's called a contango. And they got hit on that as well. So what we've got is this market where prices have absolutely collapsed on oil. They had gone long and lost money on that. They'd lost basically $100 on oil. And they got hit on the contango. They got hit on every side of that trade. Obviously, the move by the Russians and the Saudis backfired. It backfired on them because what we saw was a huge glut of oil developing on the international markets. And what happened there was that they met on a number of occasions to try and cut oil production globally. And they originally decided they were going to cut about 9 million barrels a day, 9.7 million barrels a day, which unfortunately for them didn't really work very well. Most countries in OPEC or OPEC plus produced much more oil than the cuts recommended. And as a consequence, oil remained very, very weak. And there are huge stocks of oil all over the world. For example, when Cushing filled up, what we saw was the oil industry chartering large numbers of ships around the world, 700 oil tankers, and filling those oil tankers up because they couldn't find land-based storage. And one of the consequences of that is that it just meant that there was this huge glut of material all over the world. Now, Saudi Arabia may produce oil at maybe $5 or $6 a barrel. Russia produces it at about $30 a barrel. But that's not the end of the story, because these countries are incredibly indebted. And actually, what happens is, to balance their budgets, their actual cost of production rises very substantially. So many countries, both within OPEC and outside of OPEC, have been producing oil below the cost of production, and they've been losing money. And this has been exacerbated by all sorts of other problems. One, banks are not willing to lend money to them because the oil price is extremely low and they hadn't protected themselves through hedging. Only 77% of the cuts were actually implemented. A number of countries refused to do it. And even Saudi Arabia and Russia didn't meet their requirements. And this failure of OPEC plus to extend these cuts basically failed. And we saw a meeting of OPEC this weekend on the 10th, where they decided that what they were going to do was to extend the cut phase to the end of July. But it's, you know, they have no way of enforcing any decisions, and I think that compliance is going to be very low. There's a problem there that I think will be with us for some time. So negative pricing. Negative pricing is not new to the world economy. If you think about Japanese interest rates, they have been below zero for some time. That has now been extended to many other countries, and we see countries like Switzerland, Canada, Germany, and Sweden in particular having negative interest rates. The United Kingdom has recently launched a bond below zero. So we see a large number of interest rates which operate well below below zero. We also see lots of energy contracts, oil, natural gas, electricity, and the like, also operating below the cost of production. This happens when, for example, more electricity is produced than is required. There's no such thing as being able to store electricity, so it's dissipated. And the same can be said with natural gas. You can't just shut down a well or a gas well because the problem is it costs you enormous amounts to relaunch it, and very often it ends in disaster, and you can no longer relaunch these problems. These gas or oil wells. Negative pricing is nothing new to the world economy, but it's combined with a number of issues that I think pose real issues for the global economy. I think the fact that banks are now exiting the market and are no longer prepared to lend to companies who are producing below the cost of production. Why would they? And banks who are constrained by Basel 1, 2, 3, and 4, where they have to have enormous capital adequacy set aside to back up every trade, I think has frightened a lot of banks out of this sector. And I think one of the consequences of this is that we are likely to see closures of wells in the Gulf of Mexico, in Algeria, in Iran, in the United States and Canada. So we are likely to see some shut-ins, as they are called, where closures will become permanent. So bank lending is disappearing fast. We're seeing a number of shut-ins taking place around the world. We're seeing global potential trade wars occurring where the United States will not allow its self-sufficiency in oil to be challenged. And I think that we will see duties imposed on non-US imports into the United States. And the consequence of this is we're likely to see relatively strong inflation reappearing as commodity prices eventually rise. We're also seeing a lot of talk about shortening of the supply chains and reshoring of industrial production to the major economies. And I think that's partly a result of the banks refusing to lend to these sectors at this stage, and because of low prices, and because we're talking about very old technologies here, I think that will lead to some kind of shorter supply chain event taking place. So I'm concerned that I've sort of been talking for a while, and I don't want to hog the discussion. But what will this oil, what is likely to occur is that we are likely to see a continued glut of oil for some considerable time. We are likely to see, when there's a huge stock of oil, what tends to happen is that the refineries take that oil and turn it into distillates of various kinds, like aviation gas or heavy fuel oils or whatever, diesel. And of course, that demand has also collapsed. And so they need to store that clean material somewhere, and that adds to the glut of material that exists at the moment. So until there are shut-ins, until there are permanent closures, I suspect that the oil market is likely to remain in a very difficult situation.
Okay, brilliant. Sorry, I thought you finished.
No, done.
All right, brilliant. Okay, can I just ask you one question before I go out to the audience? Is just as an initial comment. One of the things that's been happening, maybe it's just in the pages of the Guardian or something, I don't know, is this idea of, but also referencing that Bernard Looney quote I said earlier about whether this is great news for renewables or something. Do you get that sense that this is going to help the shift towards renewable energy?
Okay, no. 85% of all energy produced today is through fossil fuels: coal, oil, natural gas, and various other gases. Very small quantity is in renewables, and that includes hydro. So you've got hydro, you've got wind, you've got solar, and biomass of some description represents about 4 or 5% of global production. So we're a long way off from moving away from fossil fuels, a long way. I've quoted this a few times. There are currently 700 coal-fired power stations being built. Right? There's nuclear energy is being relaunched in Japan and other countries. So my view is we're a long way off from this, and it's pie in the sky to think that solar or wind can replace the kind of energy that is required for heavy industry to operate. It just can't do that. And none of them are carbon free. The only carbon free technology that we have is nuclear.
Right. Okay. That's very useful. Thank you very much, Rob. Right. I'm going to cancel the spotlight, and it's coming on to me. So I'll give Rob a little chance to catch his breath, and so I'll take the discussion out to you now. So if for those who want a little reminder, in Zoom there is an option. It's down the bottom on the on desktops. It might be somewhere else on iPads and things like that. There's a box called participants. If you click on that, you'll see a list of people that are here, and also you get the opportunity to raise hand. This is a button that's there, so please take advantage of that so I know you want to speak. And also, obviously, there's another button down the bottom there called called chat, and you can also make contributions in there as well. I'll try to keep an eye on that and people's comments there as well. Right, okay, I'll start the discussion. So I'm going to go to Paul Reeves first. Paul.
Hi there. Hello, everyone. Thanks, Robert. That was very interesting. It's a bit of a historical thing. I just wondered if all of these sort of financial tools, hedging in futures, etc., I guess wondered if you can fill in a bit of a history of them. Have they basically always been there? Were they there sort of pre the 73 oil crisis? And I suppose coming on from that is, as someone is a sort of complete outsider, are these kind of valid mechanisms that you see as an essential thing in operating in the market? I can understand why people buy futures, etc., from an individual kind of view. Or I wondered, is there any connection to the other theme that we often discuss in the Economy Forum about the sort of financialization of the world's economy? Are they just one of the things that is a feature to attempt to deal or hide other problems in a sort of basically a weak economy? And basically, do they help? Are they fundamentally a thing that is part of the actual economy based around sort of the petroleum, etc., or are they something that are they a bad thing? I guess basically, as far as a normally operating strong economy, I guess.
Okay, brilliant. I'll take 3 or 4, so I'll come to Jenny Cunningham next. Hello, Jenny. Oh, sorry, I'll try unmuting you again. Can you unmute yourself, Jenny?
Yeah. Okay. Thanks, Rob. I've got a very basic question, really. I wanted to ask a bit about OPEC. and the relative balance of power within OPEC. I mean, obviously in the past, it has been able to wield a certain amount of control over its membership. So I just wondered about the balance of power within that. And a sort of another question, if I may, you didn't mention China in terms of the world economy, and obviously it has been a fairly critical player in terms of the amount of energy it's basically using. So to just ask a little bit about that as well.
Great. Okay. Thank you very much, Sabina. I think people should just unmute themselves, actually.
Okay. No, I just wanted to confirm what was said about the alternative energy, because to be honest, we've got negative pricing in Germany on the energy market all the time through the wind turbines, because of the system, because of the guaranteed contingencies these companies are allowed to feed into the net. There's basically just one choice, either to switch off the wind turbines if there's an overproduction, let's say in summer when we have wind and low energy use, or it is selling the excess electricity which is being generated through negative pricing. And it's, to me, it seems to me, massive, these are massive costs. So, the system you described, the kind of storage costs for oil seem to me probably, I don't know what the costs are, maybe you have an idea, but what are the costs, let's say, per energy unit? Because it seems to me the alternative energies, even, with comparing, the cost of overproduction seems to be massively higher. So just to confirm the point that I don't think there is an alternative to oil.
Great. Okay. Mehdi, can you unmute yourself?
Okay. Can you hear me?
Yeah.
Thank you, Robert. If I may, taking a leaf out of Jenny's book, ask you two questions, please. One with respect to the shale oil. How sustainable is the production of shale oil, especially in the United States, would be if this trend continues? Okay. And my second question, Robert, is obviously everyone is praying for a V-shaped recovery. But if we're going to have a U-shaped, and if it's going to be an elongated U-shaped, what would the impact on the oil industry? And at the back of that, how resilient is the industry? These countries, whether it's United Arab Emirates, Saudi Arabia, and other countries, they've been selling oils at approaching $100 a few years ago. Therefore, they must have tremendous reserves. But how resilient is it? Because are they crying wolf in a sense at the moment?
Great, those are great questions. I'm going to take John Rowland, and I'm going to let Rob just answer a few of those, and then we'll come back out to the audience. So, John, can you unmute yourself?
Right, hello. Very quick question. The trauma has been experienced by oil. Does that apply equally to gas, or is gas somewhat more resilient given the world's dependence on gas for its domestic energy? That's it.
Brilliant. Okay, nice and short. Okay, Rob, I'm going to bring you back in. So, why does it unmute? Can you unmute yourself? Doesn't seem to want to let me unmute anybody.
I'll have a go.
Okay.
Okay, just a few points. Just on China to start with. China is the world's largest consumer of oil, next to the United States, but it's a consumer. It doesn't produce much oil. And the same could be said for countries like India, South Africa, and a number of other countries which just don't produce oil, and they are subject to whatever the global price is. They do have storage capacity, but beside that, they still are they still have to respond to the global oil price. I just want to touch on futures and options trading. I think this is very important. First of all, there's been futures and options trading both in the United States and in Western Europe for 150 plus years. And what that is all about were merchants, traders, producers and consumers meeting together to use the market to protect themselves. So if you are an oil producer, your risk is that between the time that you drill for the oil out and you sell it to your customer and your customer pays for it, the price goes down. So you as a producer would be a forward seller on a futures exchange to protect yourself against a falling market. If you are China or South Africa, you are a consumer of oil. You don't produce any oil. So your risk is diametrically opposite to that of a producer, that the price potentially could go higher. So you would hedge by going long of the market, by buying forward to protect yourself against a rising price. And industry have done this for a very, very long period of time. In the last 20 years or so, what we have seen, and it started off with the financialization of the oil markets, where because it was such a liquid market, lots of speculators got involved in the market. They could be hedge funds, they could be ETFs, they could be sovereign wealth funds, they could be commodity trading companies or trading houses who speculate on the price. And I have to say that one of the things that has happened in the oil market in April was what I would call the hyper-financialization of the market, where the speculators started dominating a market, and they really got very badly burnt because of this rolling of their positions that they had to do, and the fact that they had to pay that contango price. You know, I think industry does to some extent see them coming. But there are other elements, other people involved in the market in this hyper-financialization process, and those really are high-frequency traders. High-frequency trading is where a computer makes an algorithmic decision about which way the market is going, and over the last 5 or 10 years, maybe less than that, they have come to dominate the liquidity in the markets. So that's a big issue. But remember that these markets have been set up and are primarily used by industry to manage their risks. The WTI contract specifically attracts the financial markets, while Brent in London will tend to attract industry. There's a difference between London and New York in that the contract on the WTI contract is what we call a physically settled contract. If you don't close your position out, you have to take physical delivery of oil. London is a cash settled contract. That means it's automatically closed out if you don't close it, and you just pay or receive a difference in price. Talking about OPEC, going on to that question. So originally set up by 6 countries in 1960, Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. 4 of the top 6 producers never went near OPEC, so we don't have China, US, Canada, and Russia involved in it at all. And what's called OPEC Plus is another 11 producers of oil who have joined at various dates since that time, including Indonesia, Libya, UAE, Algeria, Nigeria, Angola, Equatorial Guinea and Congo, and those sort of countries have joined OPEC too. Remember what I said about the oil price, and it's not just the oil price that is important, it's what these countries have to produce oil and to sell it at that is important. So if you take Iran, for example, their actual cost of production works out at $195 a barrel. Today it's trading at $42 a barrel. Algeria, $109. Venezuela, I hate to think what it is, but it's most probably in excess of $300. Nigeria closing in on 100. Saudi Arabia, 83. UAE, 70. So it goes on and on and on. Bahrain, 90. So none of them are producing at a profit at the moment. They cannot meet their budgetary requirements. They cannot pay their debts. So what has happened is there's been less and less investment in oil over the last 10 to 15 years, as the banks are no longer interested in lending to people who can't pay them back. So unless it's a vanity project by a government like China or Venezuela or whoever, unfortunately, the banks, there is no way that these funds can be repaid unless, of course, oil goes over $100 a barrel or so. Sabino's point about wind and Germany is very, very true. Germany's in the market on a daily basis. All the major producers, RWE, whoever it is, they are all effectively, when the wind blows, they have to sell energy to Sweden or to somebody else in the Connect, the Netherlands or whatever, and basically they have to give it away. And it's a very unproductive way of producing energy. It's easy to switch off a wind farm. That's not a difficult problem. The problem comes when you're producing nuclear power or you're producing natural gas or oil. Here, it is almost impossible to close down without incurring a massive cost, which is impossible to recover. Shale oil is to one of the questions, is a very dirty process. The tar sands projects in Canada, the shale oil projects in the United States have created a situation where those countries are no longer dependent on OPEC for their oil. They produce more than they use and they export some, but there is just too much of this material around. They too have to make cuts, and some of that technology is ancient. And again, they can't find any kind of funding from banks. Gas has been operating at very, very low levels for a very long period of time. It is used by many countries as an alternative source of energy. Unfortunately, a lot of countries view that as political risk because they have to deal with countries like Algeria and Qatar in particular. And so they're very nervous about where this, and of course Russia, they're very nervous about long-term supplies. And so despite the fact that there's a glut of material, it's trading at about $2.80 per unit, which is a MMBTU at the moment, which is historically in the last 10 years quite a high price. So there's the gas. The recovery, I have no idea where we're going to on the recovery. I suspect, given what's going on in the US at the moment, that we're more likely to see a V-shaped recovery than a U-shaped recovery or a W-shaped recovery. But I'm guessing.
Great. Okay. Now I'm just going to throw in a couple of things. Roberta asked in the chat about Norway, and I'd just like to expand that. So obviously this is closer to home. I know the North Sea hasn't been a major producer for a while, but clearly it can only produce profitably at much higher prices. So what's the future looking like for Norway and the future independent Scotland and its oil the oil dividend? So there's that, and then also I was really fascinated by what you said about these actual prices of production and why people are producing oil at all. And also, I mean, we know from looking back at the history of Venezuela and the Chavez era that they had a lot of oil, and therefore the government could be relatively generous at a particular point in time and sort of mask certain economic problems. And obviously that's not happening in Venezuela right now. But that must be a real problem for lots of other regimes like Iran. And Libya is a mess and all that, but a lot of these countries are very, very dependent. Saudi Arabia as well, very, very dependent on having a lot of cash from oil to sort of sustain the regimes in those countries. So what's going to happen there in terms of international relations and all that sort of stuff? So 2 from me. I'm now going to unmute Daniel. Daniel, what do you want to say?
Well, I've got 2 questions for Rob. I should be clear that I do agree with what he was saying in terms of the main tendencies. But these are questions about what might be called the counter tendencies to what he's talking about. So, first of all, in relation to oil being a practical and hydrocarbons more generally being practical energy sources, I'm sure that's true. And in fact, I was amused to read recently that Germany, with all of its hype about the energy transition and becoming, focusing on renewable energy, opening a coal-fired power station. So I think that really in fact endorses your point. But on the other hand, I am following this discussion of the green recovery, and perhaps it is partly hype, but there does seem to be a concerted drive by policymakers to try to push people away from fossil fuels. So for example, to allegedly not bail out too many airlines, when you have scrappage schemes, just to do it for electric cars rather than diesel powered cars or oil cars. Although I appreciate that even electric powered cars might ultimately rely on a coal fired power station. But even then, there is a big push in the direction of moving people away from hydrocarbons. Also talking about stranded assets. In other words, threatening people who invest in oil or coal that their assets might just become wasted because people will move in a different direction. And then the other question is about other lenders, because you talked about banks not lending to oil companies. And I appreciate probably not anyone wants to lend to oil companies at the moment, but if you go back a few months, what about other kinds of lenders? So for example, asset managers, pension funds. As far as I can tell, some of them were quite active in lending to the oil sector, particularly shale oil companies. So if you could say something about that as well.
Thank you very much. Jagdish.
Right. Oh, hi, Bob. It's been 40 years since we last met on the streets of East London. You haven't changed a bit. Got a very trivial question. I'm just trying to imagine where all this oil and gas is being stored, because I know working in engineering generally, if you're working in just in time, you don't have large warehouses empty just waiting to store, store excess stock. Where is in the last 2 months? Where is all this oil and gas, and where is it being stored? So I don't know, or is it just being burnt off? So that's my question.
Brilliant, thank you very much. Noah.
Hello, good evening. Thank you very much for your reflections. Really interesting, not least the economic analysis of the price of oil plummeting. Just a quick one from me. We heard earlier reflecting on the 1973 oil crisis and how that led to the creation of the G7. And I wondered sort of more broadly how you thought this oil crisis could impact geopolitical relations, at least for nations like China. you're talking about who are dependent on oil rather than producing it themselves, and also just a sort of broader look at intergovernmental organisations and the impact of any, if any, of the oil crisis on them, especially when many of them, like the WHO, have been criticised for their response to the broader coronavirus pandemic. Thank you.
Brilliant. Thank you very much, Noah. Phil Mullan. Oh, sorry.
Hi.
Yeah, go ahead.
Thanks, Rob, and thank you, Rob. Very helpful introduction. Just to add something to your point about, or your response to the question of financialization. Very helpful what you said, explaining the long historical background of derivatives trading and even of speculators. Can you just add a bit on your use of the term hyper financialization, because and whether you'd agree with one of the differences which I think is happening in the last sort of 20 years, because there's always been derivatives markets, there's always been it's used by traders to manage their risk, there's always been people speculating on commodity prices. But what it seems to me has changed is that these prices, or what's happening in these markets, is something which has become much more mainstream within the financial institutions. It's not just hedge funds who are seeing they can make some money on it. It's the big pension funds, it's the insurance companies, it's the wealth funds. And on the retail market, it is what you described, the ETFs, the exchange traded funds have become a huge thing. And it seems that it's the impact of that allocation of funds in society, and we know there's a huge amount of money out there, but that allocation by institutions and by retail investors relatively more into commodities compared to equities and bond trading and so on, which seems to me was the factor which reinforced the exaggeration of the oil price changes earlier in the year. So would you share that as one of your features of hyper financialization? Secondly, in other forums, economy forums, we've looked at to what extent the impact of the pandemic lockdowns has changed things, or more generally reinforced or brought things to the surface. So if I can just sort of suggest three things which I'd be interested in your comments on. Firstly, on the supply side, and echoing what was being asked about shale oil in America. Because to me, it does seem that what's happened over the last few months has emphasized just the fragility of the business models of those oil companies. I mean, we have anticipation of a whole slew of producers in America in the shale markets going bankrupt. Chesapeake Energy, which is one of the pioneers, is supposedly on the brink of bankruptcy at the moment. And that whole business model of relying on debt in order to fund the drilling of wells on the expectation that somehow there'll be enough funds generated from the oil before it runs out. As we know, these fracking wells have a very short life compared to traditional wells. That market, that business model just doesn't seem to be working. And what we've seen in the last few months, to me, seems to more emphasize that. So don't you think there's a longer term problem for the US shale oil market, given that they've been increasing productivity, given they've been trying to work through this model to find a different one? They don't seem to have come up with it. Second point, sorry, more quickly perhaps, on the demand side seems to be what's important over the next few years, in that what we've seen with the lockdown enforcement, or the lockdown reductions on demand, and therefore the impact on the pricing, isn't that a precursor to what we can expect to see with a much more protracted, in my view, depression in the Western world, and even within China, the rate of growth continuing to tail off? Still positive, but compared to what was happening in the previous 20 years, it seems that the pandemic lockdown to me has emphasized that there is a reduction in demand for fossil fuels, or rather the rate of increase in demand for fossil fuels will be tailing off, perhaps is a better way of putting it. And that's something which I think is a structural shift. And finally, the other thing which seems to have been highlighted by the experience of the last few months is the politicization of the fossil fuel market. And there I would echo comments that Rob Lyons made earlier, that Daniel's just made, it seems that it's not just about supply and demand, and it's not just about financialization of the markets. The markets have become more politicized, both domestically in terms of the green agenda, where you have major companies, most of the big companies now putting forward demands that the government should get real on green, on carbon taxes, on making real zero emissions targets. That is a shift which has really consolidated, I think, over the last few years, and has been emphasized during the pandemic. So isn't that the politicized effects of that is something which is going to change things structurally in the future, I would suggest. Right.
I'm going to bring Sally in, and then I'm going to give Robert another chance to respond to quite a lot on the table. Sally, the floor is yours. Oh, I can't hear you. Oh, I've unmuted you as you unmuted yourself. Can you just unmute yourself? Sorry. Yes, well done. Sorry about that.
Sorry,
Yeah.
very confusing. Fascinating conversation. My questions seem a little bit born of ignorance, I suppose, but I'm going to ask them anyway. So the first question is a little bit related to what Phil Mullan just said at the end, which is the demand for ethical investments for pension funds and any investment fund now to be ethical, and ethical means not oil and not gas. So how much of an impact has that had? And then it's absolutely fascinating to hear that discussion about the price of oil and in effect the impact of negative pricing. But then given that the agenda is it's a green agenda, which is anti-oil, what does this then mean for all this surplus oil? Because you're saying it's too expensive to close down production, and yet there's nowhere to store it. So I'm just wondering, how do you dispose of it then? What do? Do you end up disposing of it? And does that, where does that play into the green agenda? That's it.
Great. Okay. I'm having this same dilemma about storage myself, because I see the prices of oil have plummeted at the pump, and I was just like, if I could store like 5 tank worths of fuel at the moment for the car, I'd be so happy. Right. So apologies to James. I'll bring you back in shortly. But Rob, do you want to respond to the things that have been said so far?
Okay. Can you hear me? Good. I'm going to go at this in a sort of roundabout way. It costs about $1 per barrel to store for a month, okay, in a land-based storage facility. Cushing has equivalent of 76 million barrels of storage. The United States Strategic Reserve Board has about 300 million barrels per storage capability. The Chinese have 500 million barrels equivalent of storage, and every other country has storage facilities. You see them all over the place, the big white tanks where oil, gas, and distillates are kept. Crude oil is what we call dirty tanks, and the distillates are kept in clean tanks. So it costs roughly about $1. What we've seen since this crash has occurred, and this massive quantity of oil that is being pumped out, has also been put on board 700 ships, which are basically filled up with oil and left outside certain harbors. You see them outside Singapore, in the roads outside Singapore. You see them in Southern Africa, because Southern Africa is halfway between Europe and the oil source, so they can be delivered relatively quickly. Japan, the South China Sea, anywhere where pirates don't operate. Companies like Glencore, Trafigura, Vitol, Mercuria, these are the big trading companies, have hired these ships, chartered these ships, as we call it, for lengthy periods of time where they store materials. So there's plenty of storage capacity globally. It was particularly the WTI contract in the United States that failed to not enter into negative territory. So, okay. Just to go back to a few other points. Yes, let's talk about ethical investments. And we have seen a number of companies either withdrawing from buying shares in companies that produce coal, iron ore, basically gas and oil. And in particular, the ironic one is the Norwegian State Pension Fund, which its entire wealth comes from fossil fuel production, has withdrawn from the coal market all of a sudden. And companies are following, some companies are following this concept of ESG, environmental, social, and governance policies, where they are talking about ethical investments. The interesting thing is, one, their places have been taken by other investors pretty rapidly. And I think that's very interesting, because people recognize, investors recognize that commodities in the future are going to be at a much higher price. Why? Well, the banks aren't lending to the commodity companies. The technology is becoming aged and corrupted. We're seeing fewer and fewer new facilities come on stream, and there's just going to be inflation again as a result of all of this. And I think that commodity prices will rise as a consequence of this. And plenty of people have seen the opportunity to get involved in these markets. So if you look at the major producers like BHP Billiton, Rio Tinto, Vale of Brazil, Pemex of Mexico, etc., their share prices are relatively okay. They have been underperforming, but they are, that is because we're in a low commodity cycle at the moment, but I think that will change. Why are companies producing oil at all? I think it's got to do with most countries, oil is produced by a state-owned enterprise, and it is seen as a strategic mineral, and as a consequence, I think they will continue to do so. Venezuela cannot produce distillates at the moment. It can produce crude. In fact, it has the world's largest reserves of crude oil, but it is incapable of producing it. And in fact, they've just imported this week 5 shiploads of tanker loads of oil from Iran to fill the gap. And for the last 20 years, they've charged no money for oil, for petrol, for cars, for the population of Venezuela. They've had to change that, and that's led to street riots in Venezuela. I wanted to go on really to Phil's points, because I think that's and Daniel's points as well, and talk about hyper-financialization. I come out of a metal trading background, and in that, I'd say over 50% of the market is legitimate hedgers using the market to manage risk. But that's Brent and the London Metal Exchange, for example. In lots of other markets like WTI, funds have really become the major users of those markets. And so we have seen in the last 10 to 15 years, this hyper-financialization, which is largely led not by the names that Phil mentioned, but I think the biggest one in them is the high-frequency traders, the algorithmic traders who are computer-driven instruments which are purely speculative in nature. Hedge funds too, sovereign wealth funds, ETF funds are all very, very active on the market and do sometimes provide a direction for that market. I would make the point though, and I have done this before in one of these sessions, is that commodities are not driven by interest rates like gold or currencies are. They're driven by supply and demand. And that is, to me, where direction comes from. So a lot of, it doesn't matter where these markets are, people perceive whether there's going to be a shortage or a glut of material and would price it accordingly. Obviously, sometimes that goes wrong, and this is one such incident. There have been a number of other incidents like this, what we call either a black swan event, like the one we've just seen, or a fat-tailed event, where the market moves completely out of kilter, and it's driven by events like COVID or other people entering the market. So on the supply side, on the production side, I do agree very strongly with Phil. I think that technology and business, cheap money and very dirty methods of production are unsustainable. And I don't mean that in an environmental sense. I mean it in a political, in an economic sense. And I think that we will see shut-ins that will occur in the oil industry. And of course, that will lead to higher prices eventually. On the demand side, yes, it's going to take, we talked about, what the shape of the recovery is going to be like. I have no idea. But one thing I do know is that, we've already seen, if you look at capacity utilization in China, that's at the moment around 70 to 75% of what it was pre-COVID, and is rising pretty rapidly. We are going to see a recovery in the use of commodities, but perhaps not quite at the pace that it has done in the past. So what we're likely to see is, the one example I will always use is aviation gas. Aviation gas fell off a cliff in April. We barely see a plane in the sky even now. And it's likely that it's going to take some considerable time for the distillate market to re-establish itself. So that recovery will take time. The politicization of the fossil fuel industry is an issue, and we do see lots of companies now falling over themselves to distance themselves from investing in these sectors, and sort of I'm not even sure they're responding necessarily to their own shareholders' views. I think they're responding to a wider political movement on ethical investment and on environmental issues. I don't see that that's going to change the market that dramatically. As I said, people will reinvest in other areas. Just in time, Jagdish, good to see you as well. I haven't seen you for 40 years. You still look exactly the same. Just in time procurement, I think is dead in the water. I think that cheap money at the moment allows people to store material on site. I think there has been a break in the chain that we've seen in just-in-time production, and I think people will look closer to home to fulfill production from countries which they perceive as politically dangerous or difficult, where the supply chain could be disrupted. And I think issues of nationalism and other issues of state intervention in procurement lines will lead to people looking closer to home, also to soak up unemployment. I think that's likely to happen as well. But that's an issue for debate.
Okay, great. That's in itself is a big statement. So I'll mute Rob again, and James Woodhausen. Hello, James. Oh, sorry. I think we've cross muted. So yes, James, go ahead.
Can you hear me?
Yeah.
Good. Well, Rob, I don't think anybody can rival you with your knowledge of not just W-shaped recoveries, that's a new one on me, but fat tails, distillates, contango. It takes two to contango, I suppose. So I think that's all very good. And I think in any sector, especially energy and especially oil, which is, referred to as black gold and shit in equal measure, understanding the use value of what's going on and the storage tanks and the tankers and all the rest, very important. At the same time, I'm sure you'd agree, and I think Phil and Daniel reinforced, that the financialization side, which you pointed to, draws our attention, and speculation draws our attention to the exchange value side of the industry. And I was delighted to hear you point out that negative prices and all the rest are not peculiar to this use value, that they are an exchange value phenomenon, if you like, that happens independently of particular industries. I just want to say one theme, if I may, Rob the chairman, and that is that, and I'm sure Rob the speaker wouldn't disagree, that because of the way oil works, it's very easy to be absorbed by the oil market, by prices, by supplies and the 100 million barrels a day and so on. And it's very easy also to be absorbed in the vagaries of the market and of speculation, and which does play a role. But I think it's important that we stand back from that and recognize that we're dealing with political economy, not just supply and demand. And that's true in two senses, folks. First of all, labor is involved in extracting oil. And if you look at the employment of 2 to 3 million people in American unconventional shale, oil and gas plays, and you look at the unemployment situation in America today, then the loss of 2 million jobs in the very vulnerable shale industry, which is what it could come to in the southern United States, is a very political and important phenomenon at this moment in the evolution of the United States. The transport, which is responsible for 57% of world oil demand, is a major factor in the political economy of the United States. And shale oil, I wouldn't quite describe it as self-sufficiency in oil and gas. We can have a beer about that, Bob, but it's certainly not energy independence. But shale oil and gas is very important to the American revival, to American low prices of oil for manufacturing and so on. So, we're really talking about a strategic industry that has a strong political role in all sorts of ways in America. Jobs is just the half of it. You only have to look at Shell in Nigeria to recognize the labor side, political side, or Deepwater Horizon of the oil industry. The second thing in which the political economy is important is that we have to recognize that technological change in the oil industry is generally neglected by our oil market freaks, and they're not very much concerned with the use of IT in horizontal drilling and or what is called fracking in the United States, and they're not at all concerned about the fact there's not only a decline in demand for oil because of the collapse of transport, especially as Rob points out, aviation kerosene. There's a collapse of investment in oil, which has been going on really since 2014. And finally, there's a collapse in R&D around oil and gas. It never amounted to anything compared with what they're pouring into efficiency, to car engines, and to renewables in terms of R&D. And it certainly doesn't amount to anything in terms of venture capital. Venture capital is just not interested in oil and gas. So we're neither having the investment nor the technological advance that we could be having, because it's the Cinderella of R&D, oil and gas, as you might guess. So just to conclude, we need to remember these things so we don't get too absorbed by the peculiarities of the industry. And I think the thing to remember is that in terms of the politics of demand, I think there will be a decline in demand for oil-based transportation in the West, but that will be more to do with the decline in the demand for mobility and government crackdowns on mobility and lifestyle distaste for mobility. I think if you go to the East, the demand for petrol-based and diesel-based, gas and diesel-based transport is going to be unremitting. There's going to be no close down in demand there. They're only just beginning the process of car ownership and of all the rest of it. So I think one must distinguish, as we have in other sessions of the Academy, between developments in the East and the West. You will not get electric cars filling the gap that the distaste for oil and fossil fuels makes in conventional cars. That's one thing to remember. You will get a decline in mobility. You may get a decline in petrol cars, sales and all the rest of it in the West, but electric cars will not fill that gap. That's why you'll get a decline in mobility. Very important that we uphold the merits of oil as a means of transportation, and therefore fundamental to liberty, not just in America, but for everybody who wants to get out of their home.
Thank you, James. A few points of my own. On the Labour point, when I was trying to select a few songs to play while we were waiting to get started, I looked for songs on Spotify related to oil, and they're almost all country and western songs, so it suggests that's where the Labour comes from. I eventually chose There's Only So Much Oil in the Ground by Tower of Power, which is an energy crisis classic from the early 70s. I do worry about this lack of investment, and that there could be a sort of a gap if that investment fall continues, that at some point people are not going to, all that old kit starts to grind to a halt, so the shale oil runs out or it stops being produced, then there is a potential for a gap. So in terms of political in the West, political decision making and policy making, does that mean that that in itself is a driver for attempts to produce more renewables or to shift to electric? Also, with the point you made about supply chains, is that the one thing about renewables is your wind and solar and whatever is local. There is no big supply chain there. So would that be an incentive to try and push things further on electric vehicles and things like that as well? Right, I've got Paul Reeves coming in. Just to say, anybody wants to come back, please do for the next 5 or 10 minutes, and then I'll bring Rob in at the end to sort of sum up. So, Paul.
Hi, yeah, as Rob's here, I thought I'd get a bit of information to support my absolutely massive share portfolio that I need to obviously readjust. So 3 small questions. One is petroleum. In it, I'm interested to know, petroleum is also a feedstock into industry, I can think of plastic. I'm sure there's several others. So just a quick question is, what proportion of the oil and gas market is actually used as industrial sort of feedstocks? Possibly tied into the fact that plastic is clearly unfashionable, but I'd be interested to just know what the proportion of the market is. I just wondered, it occurred to me that investors are possibly looking around for other areas to invest in. So given Robert was involved in metals, I wondered, is the possibility that investors may be now looking more even to things like cobalt, rare earth metals, basically feedstocks into batteries. It may be there could even potentially be a knock-on to that, to actually increasing R&D in battery production, which could reduce the price and cost of batteries. And I'm half serious. Is something like carbon sequestration actually now more likely to come about, given that the overlap between, I assume, between the technologies that producers use? I know it's been talked about. There've been various pilot projects which have been walked around. I just wondered if there is a possibility, a small possibility, that maybe that is an industry that could possibly now not be its time, but there could be more interest in it. Okay.
We don't seem to have a massive queue of people to speak, which is absolutely fine. So I'll bring Robin to try and get through all of that lot and sum up the conversation. So over to you, Rob.
Okay. Can you hear me? Yes? Good. Okay. So I'm taking on board everything James said. I think he's absolutely right that, you know, one has to look at this as a political, economic situation, and we need to know whether something has dramatically changed that will affect the world economy. I think something has broken in a lot of ways over the last few months, and it's not just as a result of COVID. I think although that has exacerbated many of the frailties in the world economy, and I think in particular perhaps the oil market is one such example. When is peak coal? Peak coal is 2027. Okay. Peak oil is most probably 2032 or 33. So we're a long way off from peak usage in many of these commodities. And I think there's plenty of upside to come. And given the frailties that we've talked about, I think that prices will recover fairly dramatically over time. And I'm loath to, I'm not regulated by the Financial Conduct Authority to give investment advice, but I do make, you know, the point about one of the things that has occurred and why the American stock market is so strong at the moment, given what's going on. It's a bit of an irony, isn't it, that the stock market is at its, I think yesterday hit its high, or the day before hit its high point for the year. Now, why is that? That's because people have moved their investments away from certain sectors into high-yielding stocks, such as technology, pharmaceuticals, and others. And they've moved away from investing in companies that don't provide dividends or who've screwed up over the last year or two. So I think that can very easily happen in the commodity markets. As you get a shortage of commodities, money will flow back into it, and it doesn't matter, you know, whether a hedge fund or the Strategic Reserve Board or the sovereign wealth fund of a country is involved in it. Other investors will be found and will be investing in it. I'm loath to talk about individual commodities, but let's take carbon, because I think, funnily enough, Rob, I think carbon is a very interesting topic for a discussion in the future, because there was a when the crash happened in 2008, most companies found that they had a surfeit of credits. So the whole point of the whole basis of the ETF, European trading system completely failed, right? Because there was this massive excess. They basically reverted to no value whatsoever. And we've just seen exactly the same thing happen again. Prior to the crash, to this period that we're in at the moment, everybody thought that carbon credits was a great investment because everybody had environmental issues on the tip of their tongue, and massive amounts of money went into purchasing carbon credits. And so they went up to about 30 euros per ton of carbon. Right, well, the crash happens, industry comes to a halt, nobody's producing any carbon, we've got clear skies outside, there's, the environment has completely changed, and once again, the carbon trading system has failed. So nobody's learned from these issues, and it's purely a speculative bubble that pushed these things in, and a sort of moralistic bubble that has pushed these markets up. And yeah, I've got every interest, all of us do, in a clean environment. We don't want to see a messed up environment, but you do need to choose your investments very, very carefully. Cobalt, mentioned earlier, people are very nervous about the fact that it comes from one source, from the Democratic Republic of the Congo, and where there's the very questionable methods of production, and all the major battery manufacturers, whether it's BASF in Europe or the Chinese or the Germans, are all looking at reducing their exposure to carbon and increasing their exposure to nickel in electric vehicle batteries, and of course lithium to a lesser extent. So yeah, carbon is a major subject. I think electric vehicles is a major subject. It's a very interesting topic because I think it does expose, and I think James brought this out very clearly, that we're a long, long way off from electric vehicles replacing fossil fuel vehicles. I just wanted to end on, I don't know whether you want to ask further questions, or.
No, sorry, I thought you were winding up there, sorry.
Okay. Just trying to think if I've left anything out. I just wanted to make a point really about, just round up some of the points that I have made. I think that there will be significant closures in oil producing nations. I think, if I think about it, Venezuela and Iran are very close to collapse. There are other economies where oil production is very, very weak, and I think that's particularly true of some of the South American countries and the Middle Eastern countries, where a lot of this oil production is pegged to the US dollar, and there is very little chance that they will be producing anytime soon at a profit. So I think closures will occur. I think there will be a degradation of the technology that is being used and the existing fleet of producing wells. I think bank lending is a very serious issue. Just to make a point about bank lending at the moment, it's leading to something that we're seeing called a super contango. A super contango. A super contango is where the cash price and the forward price goes out of kilter with this cost of storage and insurance and freight. So the difference between today's price and a future date is normally the storage cost and the transportation cost and the insurance cost. Because banks are pulling out of the market, that means that there are no market makers who are making markets in forward prices at or around the contango price, the natural contango price. So what is happening is that that price is climbing constantly, and it's creating what's called a super contango. We're seeing super contangos for the first time ever in commodities like aluminium and, to a lesser extent, oil and gas, where this forward price is completely out of alignment. There are other elements that I find fascinating about this, is that for the last 40 years, the way in which pricing has been identified in option trading has been through a model called the Black-Scholes model, which is two Nobel Prize-winning mathematicians developed this model in the 1980s. Well, one of the things they forgot to do was to work out, what do you do when they're negative pricing? How can you price a derivative when the price is below zero? And I see banks and clearinghouses and exchanges grappling with that issue at the moment. And what are they doing? They're looking at a French mathematician from the 1930s, Bachelier, who developed a particular model, and they're now scrambling to change their models to take into account the possibility of negative pricing. So things are going on which we've never seen before. And I think bank lending in particular is a real problem at the moment. We've seen it literally come to a grinding halt, despite the fact that the Fed and the Bank of England and the European Bank have pumped in massive liquidity and provided that liquidity to the banks to lend out to industry. They're not doing it. They're not doing it. They're not doing it because the returns that they're getting on it are zero, and the chances are that the investments will go sour. So bank lending is drying up. We're seeing a rise in nationalism and the rise of trade wars. Particularly, we could pick out China, but almost every country sending aluminium to the United States has a 25% duty applied to it, and there are lots of commodities where that is the case. One of the consequences of all of this will be the reappearance of inflation, in my view. And again, when that happens, commodity investment will rise, and we will see a much more investment going into this. I think the other issue I've talked about is I do think, I may be wrong on this, and it is a topic for discussion, the issue of supply chains and just-in-time supply chains is one which I think is up for grabs at the moment, and I think that is a real game changer for a lot of companies. Thank you.
Great, thank you very much indeed. I'm just going to unmute everybody. Can we give Rob a round of applause, please? Hello, yes. So I've muted you all again, sorry. Thank you very much, Rob. Fascinating stuff and lots to digest there. I would like to buy you a pint. I can't. But if any of you here would like to buy the Academy of Ideas a pint, go to academyofideas.org.uk/donate. Our next discussion is probably going to be in early July when we'll be having a bit of a double header on Italy and South Africa. So I hope you can join us for that. I think there's quite a lot in both of those countries that's worth talking about. And then on the 7th of July, I'm pretty sure we're going to have a discussion on innovation, which is around Matt Ridley's new book, how innovation works. Matt will be introducing that himself. That looks, since innovation has been a major issue at the Economy Forum for quite a long time now, it'll be interesting to see what he has to say about that and how his theories about innovation work when they hit the real world of the economy. So it'll be fascinating to see all that. So thank you all very much for coming along, and I hope to see you again soon.